Welcome back to InvestWise, your go-to channel for smart investment strategies and financial insights. In today's video, we'll guide you through the basics of stock market investing. Whether you're a beginner looking to understand how the stock market works or someone who wants to enhance their financial knowledge, this video is perfect for you. So grab a notepad, sit back, and let's dive into the world of stock market investing. First things first, let's talk about what the stock market is. The stock market refers to the collection of markets and exchanges where activities like buying, selling, and issuance of shares of publicly held companies occur. The stock market is one of the most vital components of a free market economy, as it provides companies with access to capital in exchange for giving investors a slice of ownership in the company. So, how does the stock market work? Companies list their shares on an exchange through an initial public offering, or IPO. Once a company's shares are listed on an exchange, they can be bought and sold by investors. The two primary types of stock markets are primary markets and secondary markets. The primary market is where new issues are first sold through IPOs. The secondary market is where existing shares are traded among investors. Now, let's break down some key concepts and terms you need to understand as a beginner investor. One of the most important concepts is that of stocks or shares. A stock represents a share in the ownership of a company and constitutes a claim on part of the company's assets and earnings. There are two main types of stocks: common stocks and preferred stocks. Common stocks entitle the owner to vote at shareholders' meetings and to receive dividends. Preferred stocks typically do not have voting rights, but they have a higher claim on assets and earnings than the common shares. Another fundamental concept is dividends. Dividends are payments made by a corporation to its shareholder members. It is the portion of corporate profits paid out to shareholders. Dividends can be issued as cash payments, as shares of stock or other property. The dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's also crucial to understand what a stock exchange is. A stock exchange is a place where stockbrokers and traders can buy and sell securities, such as shares of stock, bonds, and other financial instruments. Let's talk about how stocks are priced. Stock prices are determined by supply and demand in the market. If more people want to buy a stock than sell it, the price will go up. Conversely, if more people want to sell a stock than buy it, the price will go down. Several factors can influence supply and demand, including company news, earnings reports, economic indicators, and market sentiment. Now that we've covered some basic concepts, let's discuss how you can start investing in stocks. The first step is to set clear financial goals. Determine what you want to achieve with your investments. Are you saving for retirement, a down payment on a house, or simply looking to grow your wealth? Your goals will help shape your investment strategy. Next, it's essential to understand your risk tolerance. Risk tolerance is the degree of variability in investment returns that an individual is willing to withstand in their investment portfolio. It is influenced by several factors, including your financial situation, investment goals, and time horizon. Generally, the longer your time horizon, the more risk you can afford to take. One of the first decisions you'll need to make as an investor is whether to manage your investments yourself or to hire a financial advisor. Managing your investments yourself can save you money on fees, but it requires a significant amount of time and knowledge. On the other hand, a financial advisor can provide expert advice and help you develop a comprehensive investment plan, but it comes at a cost. Once you've decided how to manage your investments, the next step is to open a brokerage account. A brokerage account is an arrangement that allows an investor to deposit funds and place investment orders through a licensed brokerage firm. There are many online brokers to choose from, each with its own set of features, fees, and services. Some popular online brokers include Robinhood, E*Trade, and Fidelity. With your brokerage account set up, it's time to start researching and selecting stocks to invest in. One of the most important aspects of investing is conducting thorough research. This involves analyzing financial statements, understanding the company's business model, evaluating management, and considering industry trends. There are two main types of stock analysis: fundamental analysis and technical analysis. Fundamental analysis involves evaluating a company's financial statements, including its income statement, balance sheet, and cash flow statement, to determine its intrinsic value. This type of analysis focuses on factors such as earnings, revenue, profit margins, and growth potential. The goal of fundamental analysis is to identify undervalued stocks that have the potential for long-term growth. Technical analysis, on the other hand, involves analyzing historical price and volume data to identify patterns and trends. This type of analysis uses charts and other tools to predict future price movements based on past market behavior. While fundamental analysis focuses on the intrinsic value of a company, technical analysis is more concerned with market sentiment and price action. Diversification is another crucial concept for investors to understand. Diversification involves spreading your investments across various asset classes, sectors, and geographic regions to reduce risk. By diversifying your portfolio, you can protect yourself from significant losses if one particular investment performs poorly. A well-diversified portfolio might include a mix of stocks, bonds, real estate, and other assets. When building your portfolio, it's essential to consider asset allocation. Asset allocation is the process of dividing your investments among different asset categories, such as stocks, bonds, and cash. The right asset allocation for you will depend on your risk tolerance, investment goals, and time horizon. For example, a younger investor with a long time horizon might have a higher allocation to stocks, while an older investor nearing retirement might have a higher allocation to bonds. Another critical aspect of investing is rebalancing your portfolio. Rebalancing involves periodically adjusting your asset allocation to maintain your desired level of risk. For example, if your target allocation is 60% stocks and 40% bonds, and your stock investments have performed well, you might find that your portfolio is now 70% stocks and 30% bonds. In this case, you would sell some of your stocks and buy more bonds to bring your portfolio back in line with your target allocation. Now let's talk about the importance of staying informed and educated as an investor. The stock market is constantly evolving, and staying up to date with market news, economic indicators, and company developments is crucial for making informed investment decisions. There are many resources available to help you stay informed, including financial news websites, investment newsletters, and online courses. One of the most important things to remember as an investor is to stay disciplined and avoid making impulsive decisions based on short-term market fluctuations. Investing is a long-term game, and it's essential to stay focused on your goals and stick to your investment plan. Market volatility is a natural part of investing, and it's important not to let emotions drive your investment decisions. Another key aspect of successful investing is understanding the impact of fees and expenses on your returns. Investment fees, such as brokerage commissions, management fees, and expense ratios, can eat into your returns over time. It's essential to be aware of these costs and choose investments with low fees to maximize your returns. Let's now discuss the concept of dollar cost averaging. Dollar cost averaging is an investment strategy that involves regularly investing a fixed amount of money into a particular investment regardless of its price. This strategy can help reduce the impact of market volatility and lower the average cost of your investments over time. By consistently investing a fixed amount, you buy more shares when prices are low and fewer shares when prices are high, which can lead to better long-term returns. Tax considerations are also an essential part of investing. Different types of investment accounts have different tax implications, and it's crucial to understand how taxes will affect your returns. For example, contributions to a traditional IRA or 401(k) are tax deductible, but withdrawals in retirement are taxed as ordinary income. On the other hand, contributions to a Roth IRA are made with after-tax dollars, but withdrawals in retirement are tax-free. It's essential to consider these tax implications when choosing your investment accounts and planning your investment strategy. In addition to individual stocks, there are other investment options to consider, such as mutual funds and exchange-traded funds, ETFs. Mutual funds pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. They are managed by professional fund managers who make investment decisions on behalf of the investors. Mutual funds offer diversification and professional management, but they come with management fees and other expenses. ETFs, on the other hand, are similar to mutual funds but trade like individual stocks on an exchange. They offer the same diversification benefits as mutual funds but typically have lower fees and can be bought and sold throughout the trading day at market prices. ETFs can be an excellent option for investors looking for a low-cost, diversified investment. Another option to consider is index funds. Index funds are a type of mutual fund or ETF that aims to replicate the performance of a specific market index, such as the S&P 500. Because index funds passively track an index rather than actively selecting individual stocks, they typically have lower fees than actively managed funds. Index funds can be an excellent option for investors looking for broad market exposure at a low cost. Investing in the stock market can be a powerful way to build wealth and achieve your financial goals. By understanding the basics of stock market investing, setting clear financial objectives, and staying disciplined, you can navigate the market with confidence. Remember, investing is a long-term journey, and staying informed is key to making smart decisions. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe to InvestWise for more valuable investment tips and strategies. Leave a comment below if you have any questions or topics you'd like us to cover. Stay tuned for our next video, where we'll dive into the exciting world of cryptocurrency investing. Thanks for watching, and see you next time on InvestWise.